Most founders consider the Series A too early or wait too long, leaving growth opportunities on the table. This video provides the framework to know when you're ready, what the market requires, and how to execute the process efficiently. This program is brought to you by the Series of Thoughts team. In this video, you will learn the Series A readiness framework, including the 3 non-negotiables investors check. We will cover benchmarks by business type, narrative building, and process timeline and parallel management. The Series A is a shift from the seed stage question, does this work, to the Series A question, can this scale? Investors need to see a repeatable engine, demonstrating you can predictably replicate success. The shift in investor expectations means you are selling a system, not just a vision. You move from anecdote to a repeatable pattern, from story to a working growth model, and from a founder-led business to a team-led organization. Before engaging with investors, every credible Series A candidate must demonstrate 3 non-negotiables: repeatable revenue, a clear growth model, and evidence of product-market fit. Repeatable revenue means your sales motion works without heroic effort from the founding team. This involves multiple reps being able to close deals, consistent deal cycles, and cohort consistency in customer behavior. A growth story is an aspiration of what you will do. A growth model demonstrates cause, effect, and economics. Investors need a model they can underwrite, showing exactly why and how your business grows and at what cost. The core growth equation requires knowing your numbers cold. This includes knowing your CAC by channel, understanding your payback period, achieving a 3-to-1 or better LTV to CAC ratio, and showing the investment sensitivity. Product market fit goes beyond the NPS score. Investors seek structural evidence in behavior, such as retention curves that flatten, organic word-of-mouth growth, and passing the Sean Ellis test, where 40% or more users would be very disappointed if the product disappeared. The retention curve is the visual test for PMF. A flattening curve signals a stable core user base has found durable value. A declining curve needs to be addressed before any Series A discussions begin. Current Series A benchmarks reflect the real bar post-2021 environment. B2B SaaS typically requires $1 million to $3 million arranged by. Marketplace and consumer companies target $500,000 to $1.5 million arranged by. Importantly, 2 to 3 times year-over-year growth matters more than absolute arranged by. Growth rate outweighs absolute arranged by because institutional investors buy a trajectory, not a snapshot. The T2D3 benchmark is triple, triple, double, double, double. Deceleration, even with increasing absolute numbers, is a red flag investors will probe hard. These arranged by benchmarks by business type reflect current market conditions. The minimum arranged by assumes exceptional growth and PMF evidence. The target arranged by allows for meaningful negotiating leverage on valuation and terms. Your metrics secure the meeting. Your narrative earns the term sheet. The 5-part investor story is a framework for crafting a compelling, coherent case that justifies institutional conviction. The 5 parts of the investor narrative are market timing, unfair advantage, proof of traction, path to dominance, and why this team is uniquely positioned to win the market. The why now argument in your pitch must explain the enabling conditions that just changed, making your solution suddenly actionable. Avoid simply stating market size. Focus on the strong enabling shift, such as new infrastructure or regulatory change, that gives you a critical head start. An unfair advantage or moat must be real. It's the reason a well-funded competitor couldn't catch you in 18 months. Real moats include proprietary data, distribution lock-in, a strong regulatory position, or deep team expertise. Investors fund companies with the ambition to define a category, not just occupy a niche. Your path to dominance slide should clearly articulate what winning looks like and how the Series A capital will accelerate that dominance. The Series A process takes 4 to 6 months. Months 1 to 2 focus on preparation, refining your narrative, and sourcing warm introductions. Months 2 to 3 involve the first investor meetings, where 80% or more will pass, which is normal. Months 3 to 4 involve deep diligence. Months 4 to 5 are for term sheet negotiation and legal review. Finally, months 5 to 6 include closing the deal. Manage this process in parallel, not sequentially, to create leverage. To successfully run a parallel process, start with 20 to 40 investors in your first outreach wave. The funnel is wide for a reason. Expect roughly 50% to take a first meeting and 5% to 15% to reach serious diligence. The chart illustrates a realistic Series A funnel. A high conversion rate from outreach to first meeting shows a compelling narrative and strong, warm introductions. Never stop after early-stage passes. They are a normal part of the process. A warm introduction is non-negotiable for Series A cold outreach to investors rounds to zero response. Seek introductions through portfolio founders, strategic advisors, angel investors, or top-tier startup lawyers and bankers. Raising before you are ready can permanently damage relationships with investors. Know the signals that mean you should wait, such as broken unit economics or plateauing growth, before approaching the Series A process. 4 signs you are not ready include broken unit economics, where CAC exceeds LTV, high or rising churn, plateauing growth, and raising out of fear. Address these issues before starting a fundraise to avoid bad deals. Acceptable churn benchmarks are crucial. Monthly churn above 3% to 5% for SMBs, or 1% to 2% for mid-market/enterprise is concerning. High churn means your customers aren't finding durable value, creating a leaky bucket problem. Use this checklist honestly before starting. Check if your MRR is at benchmark, growth is strong and accelerating, and revenue is repeatable. Confirm your unit economics. LTV CAC is 3 to 1 or better, and churn is within the benchmark range. The data room is critical after the verbal yes. A well-organized data room signals operational maturity and accelerates the close. Ensure you have financial documents, detailed metrics, and comprehensive legal and corporate paperwork. The data room should contain 4 key categories: financial documents, detailed metrics and analytics, legal and corporate information, and product and team details, including the key hire plan and customer references. Be prepared to answer tough diligence questions, like explaining your churn and improvement plan. You must detail how you acquire customers and map every dollar of the Series A to specific, measurable milestones for the Series B. Your financial model is both a planning tool and a credibility signal. Investors are looking for rigor, not perfection. They want to see that you understand the key drivers of your business and can think precisely about the future. Key requirements for your model include building from unit economics up, not top down. Document every assumption, ideally referencing historical performance. Finally, project an 18 to 24-month horizon with quarterly detail. Be aware of the 5 most common Series A mistakes. These include starting too early, pitching without a lead investor, accepting the first term sheet without competitive tension, under-preparing the data room, and neglecting the core business during the raise. A strong story presents clear market timing, demonstrable unfair advantage, 2x to 3x year-over-year growth, a working growth model, and a uniquely capable team. A weak story lacks these critical components and relies on generic claims. When negotiating term sheets, focus less on pre-money valuation and more on critical provisions. Pay attention to valuation and dilution, liquidation preferences, resisting participating preferred, board composition, and pro rata rights for future rounds. The final mile between term sheet and close requires discipline. Hire a specialized lawyer immediately. Complete due diligence proactively. Maintain business momentum, and remember that the deal is not closed until the wire arrives. To summarize Series A readiness, know the real metrics bar, build a model based on unit economics, master the 5-part narrative, and run a parallel fundraising process for leverage. Next, we delve into the specific metrics that matter, including MRR/ARR, CAC LTV, and different types of churn. This detail will ensure you track and present the precise figures institutional investors require.